Good morning, everyone, and welcome. We're going to wait just a minute or two to let all of you filter in before we get started. Okay, I see you're all flooding in from the Zoom waiting room, so let's get going. I'd like to welcome all of you to 5 strategies to maximize your business value before selling. We are so glad to have you here with us this morning. Before I introduce our speakers and get the presentation going, just a few quick housekeeping items to go over. Number 1, we have a lot of information to share with you this morning. So much, in fact, that we've put together a detailed guide for you recapping everything, which you'll receive shortly after this webinar. Also, this webinar is being recorded, so be on the lookout for an email containing a link to the guide and this recording later today. This webinar will run 50 minutes with a 10-minute Q&A immediately following. If you have any questions for our speakers, please put them in the Q&A box located in your Zoom toolbar. To find the Zoom toolbar, just hover your mouse over the top or the bottom of your screen, and you'll see the toolbar pop up, and just pick the little box that says Q&A. Now, I'd like to introduce our speakers. First off, we have Pam Bustos. Pam Bustos, CPA, is a partner at LSL with over 20 years of experience in tax planning and strategic advice for multi-state high net worth individuals and their closely held businesses, comprised in real estate, professional services, and wholesale manufacturing. Robert Fahrenhorst is a director and manager at Plethora Businesses and advises clients in the acquisition and sale of lower middle market companies. At Plethora, he is directly responsible for the completion of more than 60 transactions, including traditional sales, recapitalizations, and mergers. His involvement in these mandates includes deal origination, negotiation, due diligence, and coordination of credit facilities. Rob Connolly is an associate at Plethora and is responsible for helping guide clients through sell-side engagements and correspondingly sourcing strategic and financial investors to accomplish client objectives. He is entrusted with the analysis of financial statements, developing financial models, and in-depth examination of company operations, trends, revenue, and cost drivers, in addition to its competitive and strategic position. Well, we definitely have a qualified team presenting to you today. So before I hand it over to our speakers, I'm going to go over our agenda real quickly, and then we'll get started. So today we are going to cover how businesses are appraised, types of buyers in the marketplace, 5 value builders to consider before selling, tax planning for your sale, and then a Q&A. So now I'm going to hand it over to our speakers. Take it away.
Thank you, Jill, and hello, everyone. I'm Robert Fahrenhorst, and I'll be discussing briefly how businesses are appraised. And this is really fundamental for any business owner that has goals to sell either now or maybe in 5 years. It's really foundational to think about where your business is today and to have a benchmark for when you're ready to potentially make a transition out of the company. So how are businesses appraised? There's essentially 3 main techniques to appraise a business, which are the asset approach, the market, and the income approach. Now, the asset approach is pretty straightforward, and as the name implies, it's valuing the tangible assets of your business. So inventory, receivables, and if your company has these assets, equipment like rolling stock or machinery. So adding all those assets up, you have a component of the overall value of the company. Now, most businesses have what we call blue sky or goodwill, which is an intrinsic value above the actual core asset value of the company, but it is an essential component. The second approach to valuation is the market approach. And what we do is we compare the subject business to other companies that are in a similar industry. Very much alike when you're appraising a real estate property, you look at other properties that have sold in the area that are similar to yours, and you compare metrics. So we call those precedent transactions. And we have access to private databases, and we do research to try to find information that we can gather from transactions and match that up to the subject company. And the third method is the income approach, which is really looking into the future. And we forecast out what we think the business will earn in terms of profitability over the course of 5 or 10 years. And then we discount that back to a present value. But in practice, how does this really work? When you're thinking of going through a sale and we're out talking to buyers, how do the buyers, approach an opportunity? Well, there's a rule of thumb in our industry, and the rule of thumb is a multiple of adjusted EBITDA. So buyer says, I'm willing to pay, let's say, 6 times the company's adjusted EBITDA. Well, real quick, what is EBITDA? EBITDA is your earnings before certain expenses, and those expenses would be interest, taxes, depreciation, and amortization. And we call it adjusted because we know that, especially in a privately held business, owners might have other expenses that wouldn't necessarily continue on after the sale. So there could be excess compensation in the form of bonus or salary, or maybe some fringe benefits. And there could also be non-reoccurring expenses. Maybe there was a lawsuit and it was a one-time event. It's not expected to occur again. And so we can roll some of those expenses into the adjusted EBITDA to help drive the value of the company higher. Most buyers usually offer a EBITDA multiple range of 4 to 8. And sometimes it could be less, and oftentimes it's in that 5 to 6 to 7 range, and it could be above 8. And really, the multiple will end up being based on a number of factors, which is the size of your business, desirability of the industry that you're in, and other strengths of your company, like your employees or the mix of customers that you have. When a buyer makes an offer, it will be something similar to this, which would be, we're willing to pay, 5 times your EBITDA, and we want to buy your business cash-free, debt-free, with a normal level working capital. So cash-free meaning you as the owner, you retain any cash on the balance sheet. And if you have any long-term debt, that you would pay that debt off prior to or at the time of closing. And normal level working capital means whatever your normal balance of receivables and payables and maybe inventory, if it's applicable, that would be part of the acquisition value of the company.
All right, now let's spend some time talking about the types of buyers in the marketplace. What does the deal environment look like? The first type of buyer we're going to highlight is the strategic acquirer. Now, this is a company that's either in or related to your same industry that would be acquiring your company to capture synergies. They would do this in the form of executing on a growth strategy. They may be looking to achieve cost synergies through scale. It may be a defensive move to keep competitors out of the market and lock down a geographic footprint. And because of these synergies achieved through acquisition, strategics can often pay a premium valuation in a competitive process due to the fact that post-transaction, they are going to own an asset that is more valuable to them than potentially another acquirer. They are going to want to acquire 100% of the business and hold that asset indefinitely in most cases. A strategic acquirer can typically facilitate a quicker exit plan as well for the selling shareholder because they have internal resources, personnel, departments that can quickly fill the void that sometimes a selling shareholder who wants to exit the business presents. The second buyer is going to be the private equity buyer. This is a financial buyer with a committed fund, pooled from investors. And as opposed to a strategic acquirer, this is going to be an acquirer who really has a planned exit on the business. The investment horizon in most cases is 3 to 5 years. So they're going to, acquire a business, look to grow it and its value over the span of 3 to 5 years, and then sell it to get a return on their investment. A private equity group is going to look to apply significant leverage to the transaction to help generate that higher return on the cash invested. And in a low interest rate environment, like one that we find ourselves in today, private equity groups can be more aggressive on valuation. And we're certainly seeing that right now. Now, private equity groups will want to avoid the day-to-day operations of the business. In most cases, they would rather work on the business rather than in the business. And that's why they prefer a partnership model, one where the selling shareholder retains a piece of equity, stays active managing the day-to-day of the business. And it's important for them to place in financial incentives to motivate that selling shareholder or management team that's going to be, responsible for driving a lot of that growth post-transaction. And they do that with either a rollover equity component or earn-out targets, or something to really kind of help drive and motivate that growth. The third buyer here is the private equity strategic hybrid type buyer. Now, this is going to be a private equity group that has an existing investment in your space and is seeking to expand through additional acquisitions. Acquisition is a part of their growth strategy with that investment they made in your space. And this buyer, is really going to have qualities of both a strategic and private equity buyer. They will have that existing investment in your space, so they're going to have the personnel and resources and will be able to capture synergies. But they still, in most cases, is going to have that planned exit. And depending on where they are in their investment horizon and thesis, they may be looking to acquire you and sell the consolidated entity, that very same year. Moving on to the fourth one, the search fund and unsponsored fund. Now, this is an investment group that doesn't have committed capital. They haven't raised a fund that they're investing out of, and they need to raise equity and debt financing on a deal-by-deal basis. Now, what that means is they're going to, they have existing relationships with private equity groups or lenders that they have access to, but they don't have full commitments to be able to search and acquire businesses. So they screen, negotiate deals, assess the risks of transactions on a deal-by-deal basis, look to kind of fill in those risk gaps, prior to presenting the opportunity to their investment partners. And then, once they have a signed letter of intent, an offer letter, they look to market that transaction to their relationships and bring in the capital, post-agreement. Now, what this does is present certainly less certainty to close a transaction because that committed capital isn't there. So it's very important when working with search funds and unsponsored funds that you're doing a very good job of screening and qualifying these groups to make sure they have legitimate relationships and the ability to pull the trigger. The next one is the family office. Now, these are going to be high net worth family offices that are looking to diversify their estates. They have a high holdings concentrated in some industry. For example, a successful real estate company that's investing the existing cash flows and diversifying that money into other industries. The last one being a private party. This is going to be an individual investor who has personal capital that they've accumulated along the way that they're looking to deploy, and it's oftentimes an executive or an employee of a large corporate company with entrepreneurial goals. So now that we have some insight into how businesses are appraised and what the buyer market looks like, what can you do to maximize the value of your business prior to exploring a sale? Whether you're looking to sell this year, next year, several years out, it's wise to really always be looking to better position your business to increase its value. And the first one we're going to focus on is building a diversified or defensible mix of attractive customers. And there's two parts of that. The first one being a diversified and defensible mix of customers, essentially making sure that you're well diversified and you don't have too much of your sales and revenue tied up with one customer, and that you're attracting yourself to attractive customers. These are customers that have good growth prospects, well-recognized names, because at the end of the day, in a lot of B2B type businesses, the strength of your business relies on the strength of your customers. Now, an ideal customer list will include both an attractive roster of company names, as well as having no customer account for 10 to 15% or more revenues. Buyers will really start to get concerned at about greater than 20% of total revenues, and many will start out, will drop out of the bidding process at about 30 to 40% and more. And the reason buyers are so concerned with a customer occupying a significant amount of the sales is really the amount of risk it presents, as well as creating financing challenges as a result of that risk. There's many reasons you may lose a customer relationship that sometimes is outside of your control. And the goal here is to really de-risk the business by not exposing yourselves to these types of events and having a business that really is too reliant on one or two customer relationships. Now, what are some reasons for a loss of customer that may be outside of your control? The seller, the selling shareholder may have a significant relationship, with a key client, where post-transaction, that relationship with that customer is in jeopardy. And, the customer decides to slow down, business being sent to this vendor because that individual is no longer with the company. And this presents a risk to a buyer. The acquiring company may relocate, and the regional basis of that relationship was very important to the customer, and the vendor relationship no longer makes sense. Or the customer may hire a new purchasing manager, and the purchasing manager is eager to demonstrate value to his senior leadership team, and looks to cut costs and find vendors that are willing to do it cheaper. The customer may be acquired, and the acquiring party brings with it vendor relationships, and they look to use those vendor relationships instead. So for those reasons, you really want to do a good job of diversifying your customer mix. Now, companies can be sold with really just about any customer concentration. It comes at a cost. The transaction that we closed with the most revenue per customer was 78%. Now, having 78% of your revenues tied to one customer, presents a lot of risks in the market process. And buyer interest, during our marketing phase was thin. What ended up ultimately happening was the deal was sold at a discount. With less interest on an opportunity, there's less competition and less reasons to drive that value up. Now, this transaction sold at a discount at 5 times earnings, and from our experience, a comparative business with a better customer mix would have probably been at around 6 to 6.5 times. Another example we can look at is actually 2 contract manufacturing businesses that I myself worked on and took to market. I took 2 companies to market that were very similar in size and scope. They had the same capabilities, very similar location. They were a rock's throw from each other, similar revenue, similar EBITDA margins. But the key differentiator between these 2 businesses was the customer list. One of them had attached itself to very good customers with well-recognized names. The industry outlook was positive. Each customer had a lot of good prospects that the buyers in this process saw a lot of good opportunity to continue to grow with those customers. And the other company that I took to market was attached to, it still had a good book of business, but the industries it was involved in were highly cyclical, less stable. The growth prospects that buyers saw in this book of business were less attractive. And as I said earlier, as a contract manufacturer, a company in many ways rides the strength of their clients. The better, the former company with the better list of customers, attracted nearly 10 offers with high multiples of earnings, and the latter company had I think about 3 to 4 offers come in, and with that we kind of had less leverage to really drive valuation up on that, and it sold at about 1.5 times less than the company with the better customer mix.
So the second value builder approach is creating defensible strategies with your customers. And one of the areas we'd like to talk about is trying to avoid overcommitting with any one of your customers while still remaining a preferred vendor. I think of a transaction that we worked on last year is a trucking company, and they had about 300 power units and 1,200 trailers, and a very impressive customer list. Many of them are Fortune 500 household name type clients, and really any one of those customers could easily become the dominant client in this business. And when we had interviewed the seller of this company, we talked about this, and he said, many years ago, we took the approach that we didn't want to overcommit. We wanted to pick lanes, being a trucking company, we wanted to pick lanes and territories where we could service the customer very well in those areas and be one of the top 1, 2, or 3 vendors for them in those zones. And they said, while the customer may have preferred us to have more business with them, we wanted to service them better than anyone else. We wanted to have 99.9% on-time delivery, no issues, no left containers behind, and it really worked well. So when we went to market, the buyers were able to see, gosh, you have such an impressive list of customers, and if we wanted to, we could expand by just adding drivers and adding more equipment, more trucks and more trailers. We can immediately grow this business without even having to look for new clients. We have it built into the company. So it was really a strategy that worked well in the sense that the customer list remained diversified, and the buyer saw a lot of opportunity when they started to dig into the business. Another approach is to leverage your competitive advantages. A few years ago, we had a client up in Northern California that was a manufacturing company, and they produced parts for a commercial vehicle company, and they ended up being about 80%, nearly 80% of their total book of business. So very high risk. If that customer decided to shift their vendors around, it could be detrimental to the company. And they did a couple of things that I think strengthened their position with this client. And one is, they remain close to the clients. Their facility was literally around the corner, is about a quarter mile away. So anytime there was an issue, the customer needed parts, they could load up that truck, and in 30 minutes, they could be over there with delivering parts, solving problems. And to take it a step further, the owner, our clients, had taken a tour through the facility, and one day he said, I've got an idea for how we could maybe improve the way inventory flows through your shop. And what he came up with was a kitting structure where, rather than shipping a bunch of parts that end up somewhere in the warehouse and employees had to go and grab parts when they needed them, he said, why don't we ship you a kit? Everything that we build for you, we put them in boxes, and when the production line's moving and you're building a new vehicle, the employees can just grab a box, put it in front of the truck, open it up, and they can start, applying the hardware and all the materials onto the truck without having to go and grab inventory off the shelf. And the client absolutely loved it. They adopted that methodology across the rest of their vendors. And I think through that, it really built a lot of trust and confidence in our client that they were the right vendor to have. So what about capacity issues? If you do have a significant customer and you suddenly lose that client, unbeknownst to you or outside of your control, do you have a backup plan? We currently have a staffing business where they had a pretty dominant customer, about 50%, but they also had maintained contracts with a lot of hospitals and care centers throughout the area. And they have approximately 80 contracts that they renew every year. And we asked the owner initially, he said, hey, you've got 80 contracts. You really only work with about 10 to 15 on an annual basis. Well, what's the deal with the other 60? And the owner said, look, he said, it's tough to get your foot in the door and to get a contract with these hospitals and care centers. He said, I'm not going to give those up. He said, besides, for the new owner, if they want to grow this business, this is the perfect opportunity. Well, we're in the middle of the transaction, and actually their top customer was acquired. And they're slowly moving and sourcing their nurses from other venues. And so that was a big adjustment for our client. And fortunately, with all these contracts that they were able to hold on to, they were able to move their nurses to these other hospitals almost without any disruption to the business. So I think keeping your options open and maintaining a good relationship with maybe a smaller customer that you don't do a lot of work with, but maybe one day they could be a valuable client to yours. It's a good way to, to kind of think about that from a planning perspective.
The third area is really looking to improve your financial metrics and the quality of your financials. Now, buyers and really lenders, as you can imagine, prefer stable, growing companies more than, a larger company that maybe has erratic sales that's hard to kind of really wrap your head around. What they're looking for is consistent growth, recurring revenues, under contract if possible, high profit margins on those sales, because the ability to underwrite and lend against the business is critical in any M&A process. The bank lending piece is something that you see on, really on most transactions. Most transaction is going to include some form of bank debt that will either be a bank loan specific to the transaction, or they may have a line of credit that they are drawing on, and it's specifically used for acquisitions. And because of this, and because of the buyer's own diligence needs, the financial statement analysis and quality of those financials are essential. Ideally, the business cash flows well, has limited risk from the lender's perspective, and the quality of that financial information is strong, and that there is confidence that it can be relied upon. That's why, as part of kind of our front end process, we really want to make sure that the financials are clean, the adjustments to income are normal, and accepted. We're not sifting through a bunch of credit card statements trying to separate personal from business expense. You really want to have a good handle on the financial information, so that when it does come time to kind of turn every stone and really understand and verify, confirm the financial picture, it's not a difficult process to do so. Now, knowing that with confidence in the financial information is paramount. You can imagine that companies with annual reviewed or audited financials will generate more interest, will often result in a higher valuation, and just generally be better received in the market. Buyers, in talking with buyers and understanding what they go through, they see opportunities every day. Hundreds, if not thousands, come across their desk each year that they have to decide, where do they want to spend their time, resources, and money to pursue these opportunities. And what they don't want to do is pursue a business that leaves them exposed for potentially wasting, considerable amount of time and resources, only to find months down the line that there's issues with the numbers. The accounting wasn't done properly, and this business isn't as profitable as they thought they were. And they're, thousands of dollars, in the hole, months of time diligencing this opportunity, only to find this out. So when opportunities are coming across their desk and they see this company has audited financials, that fear of theirs and that risk is minimized tremendously. Now, let's say you don't have reviewed or audited financial statements. Something that we advocate for and encourage our clients to do is to maybe consider doing a mini quality of earnings prior to going into market. Now, what this is getting an accounting firm to go through the last 2 to 3 years of your financial statements and verifying the quality of those earnings. What this will do will help us to identify any red flags, issues, or irregularities and remedy them prior to going to market. And a buyer they'll value this information. One, it gives them confidence in the numbers, and it will allow their diligence team to, their own accounting diligence team that they're going to hire to pick up where your accounting team left off and have those working papers to kind of have a jump start on diligence and really streamline the entire process. Now, the quality of the financial information and thinking of how important it is to the M&A process, I look at a medical equipment company that I work for. They were a company that primarily sold medical supplies. They also had medical equipment that they would rent out, and it had kind of some interesting accounting dynamics that was a bit challenging for the business to manage. Inventory, which in a lot of cases with smaller businesses can sometimes be hard to manage, and they were having issues there, as well as capital leases that they weren't accounting for properly in the books. And the owner was confident that their internal accounting team was doing a good job in managing those books. And as we were going to market and generating interest, we had no trouble generating interest in this business. It was in a good end market, great margins, and was an all around good business. The trouble came when we brought buyers to the table and we had offers and it came time to diligence the financials. Every single buyer, lacked the confidence in the financials to really pursue it beyond a certain point. And it's very difficult to regain confidence with a buyer once confidence is lost. It's something that you want to hold throughout the entire process, because once the flag and the alarms go, and it's very hard to get them out of that line of thinking. So it's important to have good numbers from the get-go. So with this client, what we ultimately find ourselves doing, we put the process on pause. We kind of took everything to a halt and advised, strongly encouraged that we have the books cleaned up, do a mini QOV by an accounting team, and we go back to market once we have all the information together, so that we can have a seamless diligence process once we have a new buyer at the table. We did this, had the books cleaned up in a few weeks to a month, and we went out to market. We were able to bring new buyers to the table. Again, there wasn't any issue doing this. And we were able to very quickly sell the business, once we had the financial books in order and clean. So, although it was an expense to this client to get those books in orders, we wouldn't have been able to sell the business without doing it. And it's something that, I think if you're doing it as a routine part of the business, it's going to be a lot easier than, scrambling and cobbling together, once it's time to sell.
All right, so the fourth value builder is paint the picture of opportunity. So as an entrepreneur, you know that your business has opportunity and it has potential, and we know that too. Our job in going through a sale process is to be able to properly articulate where that opportunity is. So a simple question that you might be asked through the process is, if you're forecasting 12 months from now where you think the business will be, what would your opinion be based on? When we take a company to the market, what we found is helpful for us in conveying the opportunity of the business and where the company's heading is to think a couple levels down from just the top line revenue. So we like to look at the customer list as sort of the building blocks of where the business is headed. And maybe, depending on your mix, maybe the top 20 or 30 customers, get them on a sheet and take a look at the last 3 or 4 years of sales with that customer and see the trends that are happening with each customer. Is a customer increasing every year, or are they sporadic? Were they a strong customer 2 years ago, and then the next year they practically weren't there, and then they came back again? So what's really happening with each client, and try to get an understanding of the trends and where they're headed, so you can kind of build up a model that when we present to the buyer, we can say, hey, here's where this company is forecasted. And by the way, we didn't just create a hockey stick growth model where every year it grows 10%. We have some meaningful analysis behind our forecast, and here's the data to support it. So the buyer looking at that goes, wow, this is great. This is something that I can take to my team and explain to them why we should be excited about this opportunity, and why we should be willing to pay more, because we can clearly see the path to growth here. It's also good to look at your historical goals. And if you've maybe had an annual business plan where each year you try to forecast where you're going, go back and look at the success you've had and where you've had misses, and look at what's worked for you and what has worked. Is that repeatable? And is it something that the buyer can identify as a repeatable opportunity for growth? Now, we see companies that aren't always growing. We sometimes refer to these maybe as a lifestyle business, where an owner has grown the company to a certain level and they're very comfortable at that level. It works well for them. Maybe it provides the proper work-life balance. And sure, they could grow the company, but that might require a larger facility, or hiring more people, or buying more equipment. And that isn't always maybe in the cards. And so a question that we hear quite a bit, and we like to ask owners as well, is, hey, we understand that this is a business that is very profitable and it's worked for you, but let's roll back the clock. Let's pretend you're 10, 15 years younger, and you were going to hold on to this thing for an indefinite period of time. What would you do? Where would you invest your resources, time, and energy into the company if you did want to grow it? And buyers really like to hear, that aspect, because they know that where the opportunity is, and maybe you're not at the point where you really want to grow this thing anymore, but they like to hear, the experience and knowledge that you have with the company and where you see the opportunity. The key really at the end of the day is that we want to give the buyer confidence that you have the confidence of where the business is headed. So when they put together an offer, they're going to put their best foot forward.
The fifth area of focus here is the management team and the personnel, within the business. It's the last area of focus, and often it's the most overlooked. Is organizing your business in a way that truly sets it up to be turnkey for an incoming acquirer. We have a saying here that your business has two values, one with you in it, and one with you not in the business. And it should be every owner's objective who's thinking about eventually selling the business, to make their business as valuable as possible with them not in the business. It's common with founder-owned businesses that a lot of the value is tied up in themselves. They have a lot of the customer relationships, a lot of the vendor relationships, the know-how, the expertise, a lot of that goodwill in the company is tied up in themselves. And when it goes time to sell, it's very difficult to separate, themselves and the business, as two different things. Are they selling the business, or are they selling, themselves in the business? So it's important to, sit back and ask yourself, when you sell, how will the business be managed? Is there a clear successor identified? If not, how much of your responsibility and know-how can be offloaded to other members of the team? Is there someone maybe within the ranks that can be groomed to take over the position as the president? You might look to consider empowering some employees to take on more of your responsibilities that you have as president, and to just holistically look at the business organization and look to train, incentivize, and structure a very strong senior and middle management team as possible, so that when it is time to maybe bring someone up to fill in that role that you currently are in today, it's less of a daunting task, because a lot of that responsibility has now been diluted throughout the rest of the organization. Outside of course, yourself and your importance, but it's also important to cross-train employees for any one position. You don't want that key man risk to exist not only in yourself as the president, but exist elsewhere throughout the organization, where this individual leaves, the business is just not as successful as it is today. You really want to diversify that key individual risk. And if the business is highly dependent on you, you need to ask yourself, are you willing to stay? If any buyer that comes in and looks at the business and starts diligencing the organization, comes to quickly find out that this business really needs you in it to be successful, are you willing to stay? Because we see it more often than not, given the size of businesses that we work with, where the owner is very critical to the success of the business, that any buyer is going to want you to stay for maybe 1, maybe 2, maybe 3 years to help transition the business to a new management team or a new individual to fill those shoes, to help hand over those customer and vendor relationships, to kind of spread the brain trust that you have within you. And that's what we see from private equity groups and the transactions that they look to structure, because this is such a common way that smaller businesses or founder-owned businesses are set up. That's why they prefer recapitalization type structures, where the sellers keep a piece of the company. For example, maybe you sell 80% of the company, hold 20% of the company, and stick on board for that 3 to 5 year investment horizon to cash out the second bite of the apple when the private equity looks to sell the business. And in that investment horizon period, you're looking to kind of do a lot of the steps that I've covered previously to de-risk the business from a key individual perspective. Because in the end, as we have your products and services are secondary to people. When a buyer is looking at the company, although the products and services capabilities are very important, what's also extremely important, if not more important, is what management team am I getting in this business? Who am I getting in this acquisition that's steering this asset that I'm buying? Because they're going to have more impact on generating a return on my investment than, you know, a list of capabilities that comes with this business.
So everyone always wants to know, how much is this going to cost me in taxes? One of the biggest questions I often receive as a CPA is, will my sale be taxed as capital gain or ordinary income? In general, sellers want to sell stock or partnership interests that are generally taxed as capital gain, but with some exceptions. But buyers cannot depreciate stock purchases, and instead buyers want asset purchases in which some assets are depreciated and amortized. But then sellers are potentially taxed at both ordinary and capital income tax rates. So we often look at structuring options. Often structuring before a sale is crucial to closing a deal that satisfies both the seller and buyer. So you need to look at how your business is currently structured. Is it a corporation? Is it a C or S corporation? Perhaps it's a partnership, which includes LLCs for federal purposes, or it might even be treated as a sole proprietorship. If a restructuring is needed, or it might perhaps need a tax gross up in the sales price in order to satisfy the buyer and the seller. And if so, there's many options available that can structure a deal that make both the seller and buyer happy. For example, in partnerships and LLCs, if it's the sale of a partnership interest, it's a capital asset transaction, as I mentioned, but it could be an asset sale for the buyer, which results in a higher tax cost to the seller. And with the gross up in sales price that I mentioned to compensate the seller for the additional tax cost, this can make the deal more appealing to the buyer, satisfy the seller to compensate them for the extra tax costs that they've incurred for the asset purchase, and make everyone happy. If you have a corporation, perhaps it's a C or S corporation, and in both situations, there are structuring situations that can make more sense. If it is a stock sale, it could be structured as an asset sale for tax purposes only. So there's several top notable Internal Revenue Code elections that can be made that accomplish the goals. And so please know that in this guide, we'll provide all of these, code sections in the detail. So no need to focus in on the numbers. But some of the more common elections are a 338H10 or a 336E election. Those are both available where it allows them to make an election to treat a stock sale as an asset sale for tax purposes. The 338H10 is the more common of the two. And if the election is made, only the corporate level gained on the asset sale is recognized. It may trigger built-in gains tax for an S corporation that was formerly a C corporation. So those holding periods you might have in place are currently still applicable. But both, again, as I mentioned, types of these transactions are stock sales purchases for legal purposes, but for tax purposes, they're asset purchases and sales. With S corporations, a particular concern that we have is that prior to closing the deal, the S corporation needs to maintain its status as an S corporation. What you don't want to have happen is to buy an S corporation only to have it invalidate its S status right before closing of the purchase and then end up owning a C corporation instead. So there's structuring that can be done. One common way is to use a 368A1F reorganization, commonly known as an F reorganization or F reorg. This is very common in private equity deals. The seller receives a step up in the tax basis of the target or the selling company's assets. The same treatment applies under Section 338H10, but without needing to acquire at least 80%. And it avoids certain legal considerations that are common in asset purchases. And one of the most important things, which may not seem like a big deal, but it can be helpful in having to avoid revising contracts, is that the selling company retains its federal employer ID number, the FEIN number, so that you don't have to revise contracts. It's filing the same under the same ID. Payroll stays the same, that sort of thing. The next common discussion point in negotiations is the purchase price allocation. It should be agreed upon early in a deal structuring because it can have all the, it has all the effect on how the tax is calculated. It's so integral to the overall outcome of the deal that if it's not agreed upon early, for what sales price is being allocated to capital assets or goodwill, or whether or not there's any inventory, any other items that are being sold, that it can actually break a deal down if the seller and buyer can't come to an agreement. Each party needs to file an identical Form 8594. This is the asset acquisition statement with their tax returns. And that puts the IRS on notice that both the buyer and seller treated the sale in the same way, that they might have treated it as an asset purchase, and that there was what portion of capital gain and ordinary income rates are in effect. So to figure out how the tax is calculated, you should expect for your accountant to work hand in hand with the M&A firm, mergers and acquisition firm, and or their tax attorneys to make sure that the deal is as expected. Tax projections are generally done during negotiations, before closing, at closing, post-closing. It can seem like they never end, and that's kind of how it feels from my perspective too. You need to expect your accountant to prepare just numerous projections. In a recent $30 million transaction that our firm worked on, the buyer purchased 65% of the entity, did not intend to run the day-to-day operations. This is in line with what was previously described, how private equity comes in and they want to acquire the business, but they want the seller to retain a stake and to run the day-to-day. Since that sale, the 35% original owners have then sold to a new up-and-coming generation who to this day continues to now run the company. But during that sale, we did tax projections over a period of about 8 to 10 months, not only for the sale itself, but for the 3 individual owners of the original company. They were updated at various points in the time during the deal negotiation, prior to closing as the numbers for the year-end sale approached, at funding, and then again when a post-closing period had lapsed and there were holdback funds released. At all these points in time, it was important for both the seller and buyer to have a complete understanding of the sale, and especially for the seller. Their net cash at closing after all tax costs and fees associated with the transaction, so that they knew what to expect. As you can imagine, the seller's attorneys and accountants were also taking a look at all the calculations along the way. So it can be a very intensive process for a large transaction, because both sides, seller and buyer, has all their advisors in place and they're making sure that everything, is going as planned. But of course, as you can imagine, all of that work comes at a cost. So when you look at fees for the overall transaction in a business sale, you should expect to hire CPAs, attorneys, and perhaps a business broker like Plethora. All of these consultants bring a certain expertise to the table that's crucial in getting the deal done that you want. I found on occasion prospective clients will come to me for tax planning in advance of a large transaction. They're looking for discount advisors. They're selling themselves short. Your business may be your most valuable asset, even more so than your home or other real estate. So you should approach this business sale with that mindset. In that recent $30 million transaction I described, the total advisory costs for attorneys, accountants, brokerage fees were probably close to $500,000. But overall, it was only about 1.6% of the sales price. We often think nothing of paying a 4 to 6% commission on a real estate sale. And I guarantee you that in these types of deals, you need the best advisors at your side. So keep that in mind. I want to thank you all for joining us today. Jill's going to see if any questions have come in during the presentation that we can answer for you now.
Thank you, Pam, Rob, and Robert. Yes, we did have a few questions come in. The first one for Rob and Robert is, how is the current pandemic affecting the M&A market?
Well, I would say generally there's unprecedented energy right now in terms of the buyers' excitement to acquire businesses. So it is a good time if you're considering a sale right now. We're seeing a tremendous amount of activity. If last year your business was impacted by COVID, where maybe you had a COVID bump, or maybe your business was disrupted for a period of time, then we would look at that closer and make adjustments, or maybe bridge over the period of time where your company was closed or was down because of maybe some of the end markets that you sold into.
Okay, the next question that came in is, what is the typical market value of the companies that Plethora takes to market?
So, I guess just to speak to this, we can just look at size criteria and then kind of back into where that enterprise value looks like. We work in what's called the lower middle market. And these businesses can range from really about 5 million in sales to 100 million in sales. EBITDA figures of about 1 to 15 million of EBITDA is our general kind of range of size of businesses we work with. And those enterprise values will, again, range from 5 million to upwards of 100 million in total valuation of the company.
Okay. And we have another question. How important is recurring revenue streams to a potential buyer of a business, and how much more is a buyer willing to pay for that?
Well, I think recurring revenue is, it can have a significant impact to the business. Some industries, if you're in the service arena, I think having those service contracts is very important. And we've had a number of clients where they're more of kind of ad hoc in the sense that they don't have that recurring base. And we see buyers kind of pass over those opportunities as they are looking for those contracts that sort of renew on an annual basis, and you've got that built-in business. But not every company is going to have the opportunity to be able to, secure contracts. And so I think it really goes back to understanding the strength of the customers, how long you've had those customers, and how consistent they are with you on a year-to-year basis.
Yeah, certainly from a marketing perspective, and if we're working with a client where maybe they don't have contracts and commitments in place with customers, I can tell you that it's going to be our job to look to articulate how those relationships are sticky. And although that there are the contracts in place and commitments, that we can make the argument and position the narrative that these are sticky customer relationships, and there is the expectation that that business will continue to come in, and in a sense, it is recurring revenue basis. So it is definitely an important element.
Okay, and I think we have time for one last question, which is, my business is certified minority owned. Does that help increase or decrease the value of my business?
Go ahead.
I'll take this one. I think that all depends on how much of your business is truly reliant on that status. I actually had a business that I worked with last year that had a special designation. And it was a big focus of pretty much every buyer, and the one we ultimately closed the transaction with, to understand that designation and how critical it was to that business's ability to win and be awarded work. Sometimes it's a bit tricky because it's not always clear. Is this designation, did it just get my foot in the door, or is this designation directly responsible for me winning this work? Because you might have this designation, but you don't necessarily know the purchasing practice of the customer on the other end, and understanding why or they're using you. Is it because of this designation, or is it not? Certainly, if with a good amount of certainty that this designation is the reason you're being awarded work, that would be a discount on valuation. You want to be able to win work and have customer relationships without special designations, because chances are the acquiring party is probably not going to also have those special designations, and they would lose it upon close. And if those are critical to the business, let's say you're a women-owned business now, and you need that designation for this business to be sustainable. Now we're looking at a smaller business pool, or excuse me, acquiring pool of just women entrepreneurs to acquire your business. So I think you need to one, kind of understand the designation and if it actually is driving that revenue, and be able to quantify it. But generally speaking, I think you want to try and have a business that is successful without those designations, if the intention is to sell that company.
All right, and with that, I think we'll wrap it up. So Rob and Robert, And Pam, thank you so much for sharing your knowledge with our audience today. On behalf of LSL CPAs, we want to thank you so much for attending, and remember to check your inbox later today for a link to the recording and the guide, and that has all the contact information for Plethora and LSL as well. Make it a great day, and we'll see you next time. Take care now. Bye-bye.
Thank you.
Thank you. Thank you, everyone.
Thank you.